Are semiconductor stocks in value territory right now, or is there more downside ahead? I'm asking this question because in the last couple of weeks, we've had most of the semiconductor stocks, other than Broadcom, which will report later today, report. Most of them pretty good, right? If not all. Good commentary on guidance as well. And yet, a lot of them have seen their stock come down. So, what's happening? Value or price to perfection in a small correction? That actually rhymes. Not bad. But anyways, what's going on right now with the semiconductor stocks? Well, let's touch on one specific player here, one that is competing with Broadcom, one that did report earnings yesterday after hours, the one that is down at the time of making this video 16.7%, and that's Marvell Technology. Now Marvell, as you can see, has actually experienced a 40% correction, should we call it, from their recent highs. And so the question here is again, are we in value or are we going down lower and lower? Because if you're asking me, most of the big tech companies, if you look at their CapEx plans, they're still expected to spend a decent amount this year. If you look at guidance for most of the semiconductor companies, growth is still there. So yeah, maybe a couple of weeks, couple of months ago, a lot of those stocks were just priced to perfection because of the super high anticipation of this AI hype cycle. Now, I'm not in the camp to say that, oh, we are in a bubble, we are in the AI bubble. To be honest, I think the bubble is in the private sector, not in the public one, right? Because if you have a company like OpenAI, which gets valued at over $300 billion, even XAI, Anthropic, and all of that, ridiculous numbers. And then if you look at the publicly traded companies, to me, the bubble is in the private sector, not in the public one. So let's touch on Marvell. What went wrong? Is this a buying opportunity? Is this one of the must-own semiconductor stocks in the market right now after seeing, well, the price come down 40%? If you want to learn more, stick around. Of course, we're going to have that live stream later today with Jose. We're going to talk about, well, the semiconductor industry, fintech, etc., etc. So stay tuned for that. If you enjoy this type of videos, hit all the buttons. Would really appreciate it. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, like I said, Marvell right now down 16.7%. And you might think, okay, this is now supposed to be quite cheap, but still a forward PE here of 34, now getting a little bit closer to the 30s. The expected growth rates, if you look at the revenue forward 2 years and EPS forward 2 years, yes, it is still expected to grow quite rapidly because there is still quite some momentum with these types of companies. Although we did hear a little bit about the custom chip makers from NVIDIA saying that, oh, just because you're making a custom chip does not really mean that it's going to ramp up eventually. So maybe that's just poking the bear a little bit, but we will see. You'll see that for the quarter and guidance as well, beats across the board, just one small miss here of 0.7%. That came from enterprise networking. All the rest for Marvell, a beat across the board. Now, maybe the problem is that, well, the beats for guidance Q1 here were just too small. Too small for a stock that was already up quite a lot, even though it did already come down from $125 to $90 or so. But valuation-wise was maybe still a little bit expensive, and maybe the market was expecting a raise here. Not just a small beat, but maybe a beat and a raise. Yes, we are in that type of environment right now. By the way, for those that are interested, this is for Zscaler. Zscaler, very, very good quarter there. Beats across the board, and well, for guidance as well. So if you're interested in that, here is the quick overview. If we look at a comment that was made by the CEO, said the following: our custom AI silicon programs have now entered volume production, and we continue to see strong growth from our interconnect products. Marvell has secured multiple new design wins, including several custom silicon programs that will fuel future growth. We are well positioned for a strong start to fiscal 26. We expect first quarter revenue growth of 60% year over year at the midpoint of guidance, and we anticipate strong revenue growth for the full fiscal year. Now, this is great, right? Huge growth year over year, quarter over quarter, not that much. As you can see right now, forward PE compared to the 5-year mean here, we can see that we're getting quite close to the 5-year mean now. With the 15% drop, we are getting basically a little bit below that. Now, the Q4 numbers were as followed. So data center is basically doing, well, all of the work here. Revenue is $1.36 billion, an increase of 78% year over year and 24% quarter over quarter. And that's now 75% of the overall revenue. And that's maybe a little bit of the issue here. Because if you look at the other segments of Marvell's business, which is enterprise networking, carrier infrastructure, consumer revenue, and automotive, well, a lot of those segments have come down quite drastically since 2022-2023. Luckily for them, luckily for Marvell, data center revenue has picked up, well, it has become now 75% of the overall revenue. More on that in just a second. Let's look at the other things here. So gross margin on a GAAP basis for the quarter, that went up 390 basis points year over year and up 2,750 basis points quarter over quarter. Operating expenses down 2% year over year and down 35% quarter over quarter, so that's fine. Operating margin also huge jumps here year over year, quarter over quarter. And then of course you see the same thing here with net income and EPS. Big jumps year over year and quarter over quarter. So definitely this is a company that is doing extremely well. Even though if you look at the other segments, and I'm looking here just year over year. If you look at enterprise networking, year over year, that's down 35.32%. Carrier infrastructure down 37.7%. Consumer revenue down 38.3%. Automotive only up 4.13%. So one segment of their business, which is now 75% of revenue, is doing extremely well and basically carrying the whole load, right? All the rest are dragging the business down year over year. Although in the last couple of quarters, yes, it has recovered a little bit. And this is maybe when things get a little bit more interesting. Because if we look at carrier infrastructure, they expect growth to continue in Q1. So, okay, that's fine. Demand recovery continued in Q4. Automotive and industrial, modest recovery continued in Q4, and they expect revenue growth in automotive offset by decline in industrial due to lumpy order patterns, yielding high single-digit sequential decline in Q1. Enterprise networking, what do they see there? Demand recovery continued in Q4 and they expect Q1 revenue to grow. So suddenly we might be seeing that, well, the other segments of their business continue to grow. And so the overall revenue of the business continues to grow as well, even if data center makes up the majority of the revenue, right? We've seen that with NVIDIA, we've seen that with AMD and with other players as well, right? Data center, that's basically where the money is at. But if you suddenly see some weakness in the stock, and then suddenly the segments that have been dragging the business down, especially on the year-over-year comparison, if those segments start to grow quarter after quarter, well, then you've got a new growth story. Then you've got, in my opinion, even a better growth story, because previously what we've had is all of those segments coming down year over year, while one goes up year over year. But what if we now have year-over-year comparisons that are way easier? And so we're going to see these segments, enterprise, carrier infrastructure, consumer, automotive, etc., on a year-over-year basis. Suddenly we're seeing that grow as well quite rapidly. And I think that might change the sentiment here. Now, as for data center, which is the biggest segment, we've seen huge growth year over year, quarter over quarter. But the thing here is that they expect Q1 revenue to grow in the mid-single digits sequentially on a percentage basis, driven by continued growth in cloud and AI demand. So we're going from 24% growth quarter over quarter to now just mid-single digits, which probably here is something that, okay, maybe Q1 is a seasonally weak quarter, but yeah, this is definitely something we have to look at. There was also a very important question here about, well, what factors ensure the stickiness of your custom ASIC customers? What might cause them to seek alternative design partners, price performance? Also, what's the potential for attaching your networking products to these ASIC clients? To which they got the answer here. We engage with all major hyperscalers. Stickiness comes from 1, technology leadership, manufacturing scale and execution, strong supplier relationships, flexible business model. While highly sticky, each generation requires competitive bidding. Of course, they compete with the likes of Broadcom. And they said that attaching networking is extremely important and a key differentiator. We are able to co-architect the networking with the custom ASIC, and this is a huge value add for our customers, which is also why Broadcom has been doing so well. We gain early architectural insights, enabling optimized I/O solutions, and the market is essentially served by Marvell and one other major competitor. Of course, in the custom ASIC side, because on the other side you have NVIDIA. And so right now, at the time of making this video, we've had already some price target downgrades. So we've had Morgan Stanley take it from $113 to $90, Citi $136 to $122. Then we have Barclays, they cut the price target to $130. So basically what we have here is price target downgrades, but still quite higher than the price we're at right now. One from Jefferies here, they lowered from $120 to $100 and they say modest upside disappoints, but Amazon ASIC revenue outlook remains strong. The modest upside to estimates is clearly a disappointment versus elevated expectations from Trainium 2 heading into the print, but we do think that Marvell took further steps to confirm they will not lose the next generation 3nm. Marvell reiterated that Amazon ASIC revenue would grow in fiscal 26 and fiscal 27 and inserted and beyond. Recall, Marvell signed a multi-generational deal with Amazon back in December, so we still believe that they win 3nm if they deliver working silicon on time. And so right now, what do we get? Well, it's quite interesting because before the reported earnings, we were right on the 200-day moving average, which was also previously a resistance point back here in 2021, December 2021, which could have served as a new support, but that didn't hold. And now we're in this area, the area where previously the stock was spending a lot of time around between $70 and $75. There is an uptrend line, and if we go all the way back down, that should be in the 60s. And so to me, it's pretty clear. Marvell, a very, very good company, positioning itself very well for the future. Me personally, I'm not interested in opening a position in that company, even after a 40% retracement. But for those that have already a position or that are interested in a Marvell or a Broadcom, I think opportunities are here. There's definitely value to be found. I don't think the thesis is broken, or at least not just yet, because one quarter, and as you can see, the quarter beats across the board, guidance as well. So it's just that things are priced to perfection, and maybe anticipation was a bit higher than, well, what the results told us. So what do you think? Do you think Marvell is a no-brainer buy right now, or there are better opportunities out there? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.